Welcome to another fabulous episode of the Free Money Podcast. Sloan here, and on this episode, we are joined by Delilah Rothenberg of the Pre-Distribution Initiative. Her work focuses on reimagining investment structures to promote sustainability through stronger long-term alignment between asset managers and their clients, which is something we talk about a lot here on the Free Money Podcast. We talked to her about pre-distribution, and you should really listen to hear how she defines it. But briefly, it's an approach that aims to prevent income inequalities from occurring in the first place, rather than smoothing them out via tax incentives and various other benefits later on down the chain. We also talked to her about some of the things that sustainability-minded investors should take care to think about, like the compensation of their fund managers and the many ethical issues that come from increasing their holdings in private assets. We also touch on the consolidation of corporate power and tangible steps the asset owner community can take to invest with confidence in the future. That conversation starts about 13 minutes and 45 seconds into this podcast, but keep listening if you want to hear me and Ashby talk about a bunch of news that ties right into this discussion. And keep the podcast going after the interview for answers to questions from listeners like you and our signature garden tip. If you'd like to ask a question in an upcoming episode, just write us, freemoneypod@gmail.com, or go to freemoneypodcast.org and hit the very, very sexy, high-tech, svelte, wonderfully designed Ask a Question button. By the way, if you're enjoying these podcasts, could you please rate us 5 stars on your podcast platform of choice? It really helps us get the word about free money out to a broader audience, which may literally change someone's life. I understand if you'd rather keep all the free money goodness to yourself, but remember, we're trying our best to build an inclusive future for money management, and that means spreading the wealth. That's it for me. Until the other side of the disclaimer, take it away, Sharkbait.
Ahoy, Free Money Podcast listeners! I'm Sharkbait Buckley, the Disclosure Pirate, and I'm here to set ye straight about what's going on with this here show. Sloan Ortel works for Invest Vegan LLC, a New York registered investment advisor. Ashby Monk works for Stanford University, Adapar, Future Proof, Long Game, and various startups. All opinions expressed by either Sloan or Ashby are entirely their own, and do not reflect the opinions of their crew or any company. Clients who Invest Vegan may maintain positions in securities and strategies discussed in this podcast. Advisory services are only offered to clients or prospective clients where Invest Vegan and its representatives are properly licensed or exempted, and a client agreement has been executed. Arr!
Here comes the money.
Here we go. Money talk.
Here comes the money. Money, money, money.
Dollar.
Welcome to the Free Money Podcast. It's where we give you the Brooklyn Bay Area connection about institutional investing you desperately crave. Let's unlock some capital for more creative purposes. Ashby, what do you think?
I love it. And I appreciate that we're no longer consensus building, we're connection making.
Yeah.
Did you catch that?
That's true. I didn't catch that, but I guess now.
I appreciate how you change our slogans just on the fly. Yeah.
Yeah,
And
I mean,
that's the lack of consensus in our consensus building. This is a dictatorship.
well, I think that like any good brand needs to be changed constantly for no particular reason.
Absolutely. I mean,
You know?
you've seen like those evolution of logos over decades. You're
Yep.
like, what the hell were they thinking back then? And then then they go back all the way to the beginning 50 years later. It's all a cycle.
Yep. Yeah. So
Oh.
we'll be back to something in 10 or 15 years. We'll get the old school, the retro throwback free money branding set up.
Yep. And this is a Monday. So this is a little bit of a downer. And hey, normally we're doing these things on Fridays. This is a Monday. Kind of somebody's got the case of the Mondays.
I mean, the Mondays, they do sneak up on you at this time of year. I mean, it's like we're heading into a quarter end. We're taping this on March 28th. So, totally chill time.
For everybody.
For everybody.
Yeah, nobody's like fighting to get sales closed. Sloan, if you'll permit me, off the top. Oh, my phone's ringing, which is very inappropriate. Yeah, I'm gonna shut that down. Yeah, can we delete it? No, we can't delete it, can we?
We never
So
delete
off the
anything.
top, I know that most programs put these sorts of things at the end after, so that people don't have to suffer through them. But I'm gonna put this up front, which is very dear friend of mine, Lori Chase Davis, passed away. And I want to acknowledge her on the pod because she was astounding. And so I've
Inspiring.
been sitting on, and inspiring. And I've been sitting on this for a few months. I wasn't ready to talk about it. It was like too painful. But I think I want to talk about it now because in part she inspired this podcast. And so I want to acknowledge that. So just give me a couple minutes to tell you about her.
Yeah.
Celebrate her. We built the Sovereign Investor Institute together at Institutional Investor over the course of about 6 or 7 years. We probably traveled to 30 cities around the world, many different countries. And she was like a super host. She was like super excited about hosting kick-ass events around sovereign funds. But like, that doesn't give you even a sense of who she was. Before she joined II, she was a performer. She did stand up. She was on the Ryan show.
What?
For Rizzle. And
that's amazing.
She was one of the cats in a show called Cats.
What? Wow.
For real. Maybe that was the Traveling Cats, but she was a cat. And
very pro cat here. So that's a big deal. Yeah.
And Lori brought something really astounding to pensions. And I know like most people don't set out to be conference organizers, but when you see someone do something at a level of like absolute excellence, you can't help but like be in awe. And I think anybody listening to this pod will be like, oh, I remember Lori. They will remember this person that had kind of like the craziest energy. The way I would describe Lori, I've been thinking about this, is like that feeling when you've had a couple of beers and your friends walk into the pub and you're like, oh shit. Lori was the non-alcoholic version of that feeling. She would do that to just about every room. And people probably know as much about this, but she was in part the inspiration for this podcast. In fact, I believe the Dear Ashby segment was an idea that came out of her mouth. And part of that was because she was always trying to bring comedy into this world of pensions and sovereigns and make it more approachable. Maybe because she came from the world of comedy and was like, this is pretty boring. So if you guys could make it a little bit more funny. But because we traveled around the world together, she would always give me notes on like my talks and moderating. And she would always tell me to be funnier. In fact, at one point we would have these bets to see how many times I could add funny words into like pretty serious topics like pension fund risk management. Like if you can work in, Star Wars quotes, like, you'll win the thing. And so, yeah, I would say like, this has been a hard one for me. Lori, her energy was like nuclear, like it was free, it was endless, and it was a little bit dangerous. And I'm not going to sit here and tell you she changed the world, but I will tell you that I think she changed me and a lot for the better. And so I miss her. And I just want everybody to remember her, Lori Chase Davis, and, her two great kids and her husband and this cool life she led that had such an impact on me. Anyway.
That's a great tribute. I think like, it's funny when you say, she brought something unique to pensions. It sounds like really it was a personality.
It was,
and so that was unafraid of being, kind of herself in a world that can be, the ultimate conformist, environment.
And Sloan, not to like be freaky here, but I would often tell friends of mine that you are my new Lori. Like, because we're, here we are. We're trying to bring comedy into the world of pensions, and we're like giving each other notes on are these jokes funny? Anyway, thank you for suffering through that. I do have some news, and I will note that obituary, if that's what we call it, was not written by artificial intelligence, because we have in the past had read out those types of things. That was written by me. Okay, so news.
Organic intelligence.
Yes, exactly. Highly caffeinated, so maybe it's augmented. But other people's money. It seems to me, as the first news item, that we really need to start calling a set of investment organizations, not SWFs, but OPMs, because they exist to attract other people's money. I know I've mentioned this on the pod a few times, but just this week, 2 funds talked about the success they're having in attracting foreign capital. So these are sovereign funds, but the wealth, the W in the SWF, isn't theirs. Indonesia announced this week that they have attracted $25 billion from overseas into Indonesia through their sovereign fund. And Egypt announced that they are successfully attracting capital inward. And so I think it's just a fascinating development to see these sovereign funds. You no longer even need wealth to set them up. You just need a viable ecosystem to invest into, and it becomes a conduit.
Yeah, that's. I think someone needs to write some kind of white paper or paper about that, because that's a very important distinction that I think is lost on a lot of people. Like the difference between like the Mubadlas of the world that are, like big pools of capital akin to any other big pool of capital versus what is sort of a development finance organization blended with kind of other uniquely sovereign type characteristics.
I wonder if there's an academic that we know. Yeah.
Only there was some guy.
Some guy. All right. I'll get on it.
Not to assign you work or anything like that.
I think it's it. Next news item. Climate change. I was about to say, for the climate change fans, those for the people who want to stop climate change.
Huge fans of climate change.
Huge haters of climate change are going to be a fan of this next news item. The SEC has said they are going to obligate companies to report on a variety of climate-related risks, including how any climate-related risks can have an impact on their business, can get in the way of the company's strategy, or just simply affect their outlook. So if climate change can affect your outlook as a company, you are now, I don't know when this comes into effect, but at some point going to have to report on it. Have you seen this news?
I have. I'm actually prepping a comment letter to the SEC on it right now.
Holy cow. What do you got?
Well, okay. So I guess a couple of different levels of commentary on this, right? The first is that what is a company? What is their competitive position, if not a set of supplier relationships, right? And I think that this opens the door to structured disclosure around supplier relationships that can help us diligence companies in new and interesting ways. Right. So, I love the idea of having structured disclosure around that on climate. I'm a little bit worried when we start to think about scope 3, which is kind of one of the big questions that the SEC left open in their draft rulemaking. That when we start to think about, imagine you are like a facilities manager or something like that. And that in 2 years, you're going to have to report on scope 3 emissions, which is like the stuff that your suppliers, created, the emissions your suppliers created in order to get the stuff to you. Well, your mom and pop vendors probably aren't going to be as able to provide individualized scope 3 climate analysis as the large guys. So my fundamental concern here is does this act as a pressure that pushes people into the arms of Amazon, basically, who I'm sure will have a great reporting dashboard for you, and away from your teeny mom and pop office supplies company or whatever.
This is going to regulation crushing the little guy.
Well, I think that there are ways to promulgate. I mean, the SEC did a smart thing where they said, look, we're not sure what we want to do about scope 3 yet. I think that there are ways to say, okay, well, we could disclose on the aggregate size of our suppliers and stuff like that if we can't necessarily go all the way to full scope 3 disclosure. Right. So that really is my comment in brief, is they should, create rubrics for people to give things that are not, exactly what they're asking for, which is, scope 3 climate. I would be perfectly happy to see, instead of that, the number of minority and women owned businesses that are in there, number of businesses that they're sourcing from with revenues under a threshold, in the absence of, that detail, that we really ultimately would like to see.
Yeah. Sounds to me like we're going to need we're going to need that letter in order to have this new policy truly align investment practices with long-term sustainability.
Yeah, I mean, I think that we're, I like the way that they handled it. They
Mhm.
put out the thing, they signaled an ambition, they signaled a direction, they invited comment, and like I felt like, the door was open, and that's really cool.
My tweet about this, which I do tweet from time to time,
At Sovereign Fund on Twitter.
it's having fun. And the new at Stanford LTI.
Oh, you made a new Twitter handle. Cute.
And I'm going to pretend like it's not me doing it. So like retweet my own tweets and tweet them back and then to like them. And it's like a vicious circle of awesomeness.
It's
But
an
it's all me.
engagement factory, baby.
I think it's actually, this is what the Russian trolls do. I'm now getting a sense for what they do. They like each other's shit, but it's all their own shit.
I mean, that's what Free Money Podcast does on Twitter at Free Money for
Ad
2069.
free. Anyway, I had tweeted that I think what would have been really powerful was instead of making it about reporting on climate risk at public companies, at public pensions, because then the investors would be forced to align their practices with long-term sustainability. And the reason I keep saying that little sentence is because our guest, who is coming from the pre-distribution initiative, their catchphrase, which speaks to my inners, is how can investors align their internal investment practices with long-term sustainability? Doesn't that sound good?
That sounds so good. Let's talk to her about it. I mean, when prepping for this interview, I had like a lot of very interesting things pop into my mind.
No
So I'm really
kidding.
excited to chat with Delilah Rothenberg. And there she is.
There she is.
Hello.
Hi, Delilah.
Are you okay?
We were literally
can.
just saying your catchphrase. How can investors align their internal investment practices with long-term sustainability? It's like the bat signal up on the clouds in light.
Well, I mean, I feel like I'm just building on the great work that you continue to
Aw.
do in this space. So, um,
I mean,
yeah, really pleased to be here.
as catchphrases go, it's immensely catchy. So we love to see that. I guess maybe as a place to start off, like you could tell us what the heck pre-distribution is and how it relates to like income inequality and termisms of various terms.
Sure. Yeah. Well, thanks again for having me here. And pre-distribution is a concept that I think a lot of people aren't familiar with. So a lot of people think about redistribution when it comes to economic inequality, and they think about the importance of paying taxes or charity to address certain social issues, and that's really important when it comes to leveling the playing field or emergency situations. But redistribution to address all forms of economic inequality really allows a system that is inequitable in the first place to perpetuate. And so pre-distribution is the idea that um, we're going to pay people for the value that they create and the risk that they take in the economy in the first place, so that they don't have to become dependent on aid and redistribution through taxes or other wealthy people deciding what they're going to give charity to. And this gives people um, this gives people, working class people, more agency and also more dignity, as opposed to just recreating cycles of dependency on aid. And so pre-distribution is really important for addressing systemic inequality.
I love it. It's sometimes when we get the guests on and they start talking about what they do, it's like, this is why you're on here. Like when I hear about the pre-distribution initiative, we call it in my little world like the base of the capitalist system, and we're trying to level the playing field. But like I think your initiative, and by the way, my new project at Stanford is technically called an initiative. So we're both running initiatives.
Everybody's got an initiative now.
We're gonna get
It's either an initiative or a project.
yeah, no, I think initiatives are the new project is my is my take. But I just really appreciate the work you're doing, and like in reading your website, and everybody should go check out the website predistributioninitiative.org, because it is so similar to the work we do around like getting the measurement out there. No, do what you want with the measures, but let's measure it so we can manage it. you've noted, and I'm jumping right into another question here, that the ESG investors tend to focus a lot on executive compensation, but then classic work that we do here on Free Money is we try to go up a layer. You are too. You're saying, but they ignore the asset manager compensation. Obviously, we agree with you. That's an oversight, but like, talk to us about that whole situation and why you're focused on it.
Yeah, it was very interesting to me. I was working in private equity around 2017, and I had worked across a number of different functions in private equity that probably led me to these, you know, ideas, certainly with the help of some friends who raised some important questions along the way. So I was working at a private equity firm and I was thinking about how can we address inequality, economic inequality in our portfolio companies. And to me, it seemed obvious that economic inequality was becoming a systemic risk that investors should pay attention to, or it always has been a systemic risk, but um, that investors were starting to acknowledge that. And then there's also the SDGs, and a lot of investors are saying that they're investing in a way that's aligned with the United Nations Sustainable Development Goals, the SDGs. And there's SDG 10, which is on reduced inequalities. So it just seemed important to focus on this issue. And and I was looking at, can we pay workers in the portfolio companies a living wage? Can we help them build wealth by sharing some equity in the companies that they work for with them? Or can we narrow executive to average worker compensation ratios? And that last one is not something that's widely, thought about or talked about in the private equity space. But if you go to public equities conferences that are focused on responsible investing or ESG investing, then it's not uncommon to hear about executive to average worker compensation ratios. And I ironically was catching up with a libertarian friend of mine who said to me, Delilah, it's great that you're looking at executive to average worker compensation ratios in the portfolio companies, but you work in private equity. And the executives of the major private equity firms, maybe not the smaller ones, but certainly the major ones, make way more than most corporate executives. And it doesn't take long or, it doesn't take much research to know that he's right. If you look at um, the executives of the largest banks, they're making roughly $35 million a year. If you look at the top executives of the largest private equity firms, they're making around $100 million a year or more. And sometimes it's multiple executives at the same firm that are making that kind of money. And so people will say sometimes, well, as long as you pay the workers a living wage, that's okay, right? But wealth inequality and that differential between the top paid and the lowest paid really matters, because if wealth pools to very few individuals in the economy, and they are in a position to buy up assets like real estate and equities, then those few individuals are pushing up the valuations of those assets, and it becomes very hard. The barriers to entry to invest for other people become very high, and so that becomes very problematic. And there's lots of research that shows that this kind of inequality is a systemic or systematic, as we like to say, um, risk because of secular stagnation. So, the marginal propensity to spend of the super wealthy is not as great as those less well off. And so economic growth can stagnate. There's also research by Professor Atif Mian and colleagues. Professor Mian is at Princeton University, and he's done work with a number of different colleagues that have. Oh yeah, you're wearing the sweatshirt. Ah,
Sorry.
that's great. No, that's small world. Um, so his research shows how the excess wealth that's accumulating at the top can be used to facilitate debt financing of the less well-off spending, which can lead to credit crises. Um, and and there's just a lot of great research out there that shows how this can be detrimental to investors' portfolios, diversified investors' portfolios, and so they should really care about this.
I'm just thinking about you at a private equity firm, like sitting around going like, all right, so how do we align ourselves more with purpose? What we should do, we should really pay ourselves less. I like, number one way to make friends in the private equity industry.
Hold on.
Well, and then the other thing that I forgot to mention is there's another argument for just making sure that everybody throughout the capital markets value chain is well incentivized. So it's not just, when you're at a private equity firm, you think about incentivizing the investment team, you think about incentivizing the executive management team of the portfolio companies, but what about the workers in the portfolio companies? And so that was, another argument for doing this work. If you, for instance, share carried interest with workers in the portfolio companies, maybe you'll end up with a better net return for your investors.
I love it. Before we go to the next question, I'm hearing so many themes here that have been like basically my life's work. And one of them is like the whole net returns. You just said it, right? Like most of the big hedge funds and private equity funds are like, well, who cares how much we're making if the net returns are good? You should be caring about net returns. But the problem in this space is the boards of directors of these pension funds, they don't know what they're paying these hedge fund CEOs. And so I can remember going, and I used to have this little shtick every time I go talk to a board. I would be like, okay, so the most highly paid pension fund executives are making $2.5 million a year. This was a few years ago. And many of these people would have a hedge fund or private equity fund manager. And I would say to them of a specific list, I'd say, how much more do you think the C-suite in that hedge fund is making than your C-level executives? And they would be like 10 times. And I'd be like, up. They'd be like 50 times. I would be like, up. I'd be like, not 100 times. I'd be like, up. And they would be like, no. I'd be like, it's 1,000 times. It's 1,000 times.
Yeah.
And this industry, and then their minds would blow. And then, there would be fabulous. People would be crying. It would be like, resurrecting people with snakes. It was nuts. You know what I mean? But this whole space needs that transparency because it's the billionaire factory. Like this whole, more billionaires get created on the back of pension assets than any other industry. It's twice as many billionaires are managing pension assets than are building technology companies. Anyway, sorry, this is just so close to hope. I feel like I'm stealing your thunder. Back to you guys.
Well, no, but it's clearly like there's a lot to talk about here, and I think that, this is one of these topics that, you can understand it, you can sense it, you can summarize it, but as you keep coming back to the evidence, it'll keep hitting you again and again and again how profound the observation is that there's like multiple levels of, I guess, weird skew that these inequalities create in the economy, in portfolios and whatnot. I'm curious, what sort of things might people be overlooking as a part of this thing? You talk a lot about debt and gearing levels, and demand for private assets. If I've been, if I'm one of these pension guys making a meager $2.5 million a year, and I'm trying to make my actuarial hurdle, right? And I go and say, okay, I'm going to invest in some private debt. I'm going to invest in some CLOs. I'm going to, do all sorts of whiz bang stuff. What sorts of systemic issues could I be contributing to without really thinking about it?
Yeah, I mean, I empathize with institutional asset owners because I think they're in a difficult place. So we published this paper the beginning of last year, so April of 2021, called ESG 2.0 measure. Was that?
I said it was? I'm just blown away. I've lost all notion of time. Sorry. Continue.
I know, me too. Absolutely. So the paper was called ESG 2.0, Measuring and Managing Investor Risks Beyond the Enterprise Level. And we explore two key themes in it. One is the institutionalization of capital and the consolidation of capital flows, which I'll explain in a minute. And the other is the migration up the risk return spectrum for yield in a low interest rate environment. So on the first, capital has become very institutionalized since the 1950s. And now we have very large pension funds and insurance companies and sovereign wealth funds, endowments in the market. And they are so large that they need to invest efficiently, or they feel pressure to invest efficiently. And there are a number of other factors going on, but they tend to invest in the largest fund managers. And that's a trend that's becoming more intense as time goes on. So actually across private asset classes in 2020, only 15.7% of the funds raised were in amounts of $1 billion dollars or more, but they represented 72.4% of the total capital raised. And so, that's just one data point. But if you look over the years, you can see that this trend is getting more, is growing. So then you have these large asset managers who also have significant capital to put to work, and then they feel pressure to invest efficiently. So they tend to invest with larger and larger companies. And so the average deal size has also tripled over the past 15 years. So I think one thing when we think about corporate consolidation, which is becoming a concern to many people in society and investors alike, is that people think about antitrust enforcement or improved legislation and regulation to address corporate consolidation. But there might also be some dynamics related to the consolidation of capital flows that is leading to corporate consolidation. And when you have so much capital chasing large deals, that tends to push up the valuations. And then that becomes difficult to have strong returns for new deals. And then there are incentives to layer on debt and engage in financial engineering to generate returns for investors. And so we're in a situation now where non-financial corporate debt is at historical highs, leverage levels are at historical highs, covenants are light, underwriting standards have gotten weaker, and this can lead to a potential corporate debt crisis, and asset bubble bursting. And even before COVID, the IMF and Federal Reserve and Financial Stability Board were concerned about a potential corporate debt crisis, partly because of these trends. And they were concerned that, just a slight downturn, economic downturn, or increase in interest rates could trigger that kind of crisis. And of course, we got COVID-19, which was way worse than anybody could have ever predicted. But what happens is when you have very weak or fragile, I guess is perhaps a better word, when you have this kind of fragility in the financial system, then if there's a slight issue that might trigger this kind of crisis, then the Fed has to step in. Central banks around the world, have to step in. Then there's a need to keep interest rates low and engage in quantitative easing in some cases. And that, of course, just incentivizes more risk taking and more debt. So that's where we can end up in a potential debt trap. And, all of this relates to ESG, because one of the things that we're also looking at as when it comes to investment structures, we started with looking at fund manager compensation, but there are other issues at the fund manager level that one needs to pay attention to from an ESG perspective as well. So when we talk to stakeholders, they said, it's great you're looking at executive compensation, but we're concerned that private equity fund managers are over-levering portfolio companies with debt in the LBO space. And companies that have too much debt might not be in a position to offer quality jobs and quality and affordable goods and services. And so that's an ESG issue. But our ESG and impact investing frameworks, like GRI and SASB and IRIS Plus, are primarily focused on the portfolio company level. In the portfolio company operations and their activities, it's not looking at the investment structure. It's not looking at fund manager compensation. It's not looking at leverage that the fund manager is putting on the portfolio company. And so that's the kind of stuff that we're looking at, and we're trying to raise awareness among investors that these can be systemic risks, and really make the financial materiality case, not in the sense of these issues are necessarily financially material to each individual company, but they're financially material to investors' portfolios at a systemic or systematic level. And we're also looking at responsible tax at the fund manager level, which people are talking about at the corporate level, but not the fund manager level. We're looking at lobbying and political spend. So there are a lot of issues to explore.
I cannot applaud harder for, these looking into the debt hangover that private equity company, I am an active manager. In our equity strategy, we have a pretty big universe, and I have a whole private equity hangover category of the investable universe. And the thing that I bring it up because the companies that are in this private equity hangover category are like dialysis companies. They're like it's like healthcare and like assisted living facilities, stuff that really should not be financialized and used in that way, winds up getting sucked up into this private equity machine, taken private, levered up. The whatever capital is there gets dividended out. Maybe it meets a pension's return expectations or something, but undoubtedly that money winds up in Greenwich. And what you're left with is a company that can't really provide the services that it needs to. And in some cases, this winds up having like a very literal body count in the form of like nursing homes that can't afford to pay people good salaries.
Yeah.
So kudos to you for making that connection.
And to you.
Classic paper on that, by the way, is private equity owned nursing homes prescribe more opioids.
Yep.
That's true.
Yep. Yeah. They also prescribe more anti-schizophrenics, for people, which is like, the classic, like, well, this old person is being inconvenient. Let's anesthetize them. I'm curious, Delilah, do you have like a car parked outside of your house, like monitoring?
Are you safe?
Like, yeah,
I thought that industry reactions were going to be more like that when we first started, but then I realized like our operation is so small, like we're probably not deemed a threat yet. So
you might want to get ready. Free money's about to we're about to put you on the radar.
The free money effect, baby.
But I think that there's one other dynamic that is really important for me to mention, which is that we don't actually think that most people who are playing a role in this system in one way or another, at the fund manager level, wherever they are in the capital markets value chain, we don't think that most people are bad people. They're just simply responding to incentives in a system, in a culture that they have grown up in, that they have been educated in. And so we're trying to approach everybody with empathy. I read Steve Schwarzman's autobiography. He doesn't seem like, a really bad guy to me. He seems like he has some blind spots about his negative impacts. And I think that sometimes if you take a very activist approach toward people that you have these concerns about, then they can end up clamming up and not hearing the message and getting defensive. And so we're really big believers in trying to approach everybody empathetically and recognize the sort of the bureaucratic institutional nature of how the system's evolved, and trust that everybody has a good side to them, and will ultimately find a way to justify making the changes that we're seeking to make.
I love it. I feel like we might need a third member of the podcast team after today. You're just speaking the same kind of like vibe that we have. The funny thing here is I often play a little judo with those like private equity people by saying my goal is kind of to deregulate the space. And they're like, deregulate? What do you mean? And I'm like, well, I mean, the regulation is fully tilted in your favor. We've obligated these plans to go get 7.5%. We haven't given them the wherewithal to do it on their own. And so regulation is pushing, actuarial rules, funding rules, all the rules are pushing them into your funds. And they can't do first-time funds. They can't do second-time funds because of their governance. So literally your industry is so profitable because of government. How's that feel?
Yeah. Yeah, I mean, I think that's been the biggest lesson for the pre-distribution initiative since we started. We thought that we could convince the asset owners and allocators to encourage the fund managers to change and have more regenerative investment structures, and that the asset owners and allocators, or LPs in the private capital space at least, would see the incentive to push the fund managers to change. But actually, they don't have very strong incentives. There are a lot of reasons why LPs are re-upping with the largest fund managers and are concerned about not getting into oversubscribed funds. And I do think that if lots of people say, well, for the public pension funds, legislatures just aren't giving them the resources that they need to have teams internally to do more direct investing and to invest in smaller, emerging and diverse managers and more innovative investment structures. And I think that's very true. And I think
It is
one
true.
of the things that I would like to do is to do more engagement with those legislatures and decision makers in other contexts other than public pension funds to say, here's the business case for why you should expand your team. I actually really want to do the financial analysis around sort of the cost benefit analysis of you increase the size of your team. So what can you do with that? What might your expected return be? I need to think through the methodology of that and fundraise. Maybe that's something we can do
Please,
together.
let's do it together.
Sounds like a party.
See, it does sound really rad. CEM benchmarking does some of that, and
Mhm.
I think if I reverse, I don't know, 7 or 8 years of my life, I was doing a project on insourcing, in large part because that was the moment coming out of the financial crisis that everybody was like, "Wow, like these guys were charging us so much money and we still lost so much. And can we do some of this on our own?" Was kind of the palpable realization. And people were trying to start manage money on their own, but they didn't quite have the systems and governance and culture in place. And, there's a certain FBI inquiry going on in Pennsylvania right now, which is kind of illustrative of like how far the plans could go in the name of reducing cost. But you have to marry that with governance and
Yeah.
all the systems and risk and all that. Anyway, I think you could save oodles, and the CEM benchmarking data shows that. In fact, just last week, Australian Super came out and said since they started internalizing in 2012, they have saved $750 million, and they are
Wow.
tied for first in Australia among all super funds for performance.
That's great. See, this is why we need to talk more often.
Mm-hmm.
But that data is great to know about. And, I knew that there are a number of large institutional investors who have come to the decision that that would be best for them. I'm sure that data has been very helpful and could probably be used more widely, which perhaps we could be helpful with. There was one other thing. Yeah, there was one other thing I was going to say about direct investing by LPs or asset owners and allocators, which is that I still think that there are some policies and procedures and practices internally of institutional investors that would need to change to fully address the issues we outline in the ESG 2.0 paper. So, for instance, we talk about benchmarking. We talk about more regenerative investment structures that that fund managers could take, like revenue-based financing or redeemable equity or permanent capital vehicles or employee ownership vehicles that transition companies to employee ownership or community ownership. And these are emerging strategies that aren't fully developed asset classes yet, but it's so hard for anything to emerge and develop into an asset class when institutions have their sort of benchmarking approach and their buckets. And, you have to meet this benchmark to be in the private equity bucket. And, up until recently, there was no private credit bucket. And so when we think about what more regenerative investment structures could be other than the traditional leverage buyout private equity and growth, which we're a fan of growth private equity, our concerns are primarily with LBO. But we do also have some concerns about venture capital and think that there are we're not against LBO private equity, we're not against venture capital, but we think that they're not
Yeah.
concerns,
Yeah, exactly.
concerns, but they're not appropriate for all the portfolio companies that they're targeting. And a lot of portfolio companies could have really great futures and be very value added in the economy if they had more appropriate financing structures, particularly after the global financial crisis when banks came under pressure and they can't lend to as many small, medium-sized enterprises anymore. Well, capital markets aren't filling that void either. And so what can we do to sort of not only deconsolidate capital flows, but have more regenerative financing structures? And I think that some work needs to be done internally in policies and procedures for institutional investors to adjust that bucketing approach. Um, yeah.
I love that. You're speaking like, how do we align the capital with first of all, the end investors who want to generate the return, but the companies in the most thoughtful way. So I think sometimes people forget that, like, the end investors, the asset owners, are long-term. Most of the companies would be long-term. They're permanent capital in structure. It's the intermediaries that often drag that short horizon down for a variety of reasons. But look, I know we've kept you longer than we would. This just got really away from me, and Sloan, correct me, but I think this has been really fun. But I think we have one more question. Yeah, you're not going to correct the fun part, but I think
I'm not. Yeah, it's like actually, I'm having a terrible time.
Actually, let me correct you on that. This has been really bad.
Yeah.
It's gone by very quickly.
Last question, because you're working on so many issues that are pertinent to our audience. Like, what steps would you like to see the asset owner community taking on in the short term? Like, what are the key projects or focal points that you want these asset owners focused on?
Sure. So we have a 4-pillar approach to our work. So one is on transparency, standard setting, and disclosure, and we have 2 projects. One with the was with the Impact Management Project. Now it's with a sort of spin out organization called Impact Frontiers, and that is looking at investor contribution to deals. So the Impact Management Project has a framework for looking at portfolio companies and the positive impacts that investors can make on the portfolio companies, but they haven't really built in sort of understanding the risks that investors might cause. So we're building that part of their framework out with them. We're also working on a task force on inequality related financial disclosures with a few other organizations, and that's to map out what activities from the private sector, both at the company level and investor level, can contribute to systematic risks that we talked about, and how do these systematic risks then impact the investors. So that's something that investors can get engaged with. We're also looking at benchmarking practices in collaboration with a mutual friend, Scott Kelb, at the Responsible Asset Allocation Initiative, and Paul O'Brien, who is a former deputy CIO
in Wyoming now,
a current trustee. Yeah.
That's awesome.
So we're looking at what role do historical financial benchmarks play in asset allocation, and perhaps inhibiting addressing some of these systematic risks that we're seeing, because they don't fully price in externalities, for instance. And if we're going to price in externalities moving forward, then we can't really compare future returns to benchmarks of the past. You're not comparing apples and apples and oranges. So how do we deal with that? And also looking at investment governance, which we're doing with the Investment Integration Project and John Lukomnik and Keith Johnson, which we'd be very interested in collaborating on.
I was waiting for my name to show up on that list. I didn't know what was happening. Investment governance.
I know. We need to figure out how we're going to collaborate on all of this, because there's so much in commmen between our strategies. But really looking at how can investors account for
not strategies,
initiatives. Yes, not projects, initiatives. But how can institutional investors factor in systematic risks that are that they need to be thinking about for their long-term returns, and how does that change their asset allocation strategies? And that goes beyond just making adjustments to the investment belief statement and investment policy statement, but going through the whole docket of policies, procedures, job descriptions, TORs for committees, to make sure that the right talent and framing is there to address systematic risks.
I mean, that sounds like a lot. I, for one, await the better benchmarking with bated breath. Like I cannot tell you how much of a bugbear that is for me. I'm stuck using as an active equity manager, like basically I have to compare myself to carbon intensive indexes because that's what everyone wants to see.
Yeah.
Right. But I can't own like 70% of those stocks. So from a practical standpoint, it's a meaningless measurement.
Yeah.
And like I'm stuck writing, like I'm about to write a letter again where I'm like, here's how I did relative to the benchmark. I can't tell you enough how meaningless this is
Yeah.
in every possible way. So it sounds like everybody listening should get on your email distribution list to keep abreast of these various opportunities to dive in
Yes.
at predistributioninitiative.org.
Yeah. Yeah, that would be great. Thanks. And let's stay in touch and see what we can do together.
Awesome. For Sheezy.
For Sheezy. Yep. I don't know what that means, but I think it means.
I think it's
yeah.
for sure. I don't know. Yeah, like it does mean yes. It does mean yes. Thank you so much, Delilah. Long distance high
Yep,
five.
thank you.
High five.
Bye bye.
Bye.
All right. Take care.
She's
Wow.
fabulous.
You know,
and that you say it.
every time we do a podcast, I feel less alone.
Do you know what I was gonna say? Like what I was about to say was I would do this if it was just me and you listening back. You know, like if we didn't
Yeah,
have
same.
a single listener. Like there's a great SNL skit where there's a podcast skit for guys. Have you seen that one?
I've seen them.
Very good. If that was the podcast tool that we were using instead of actually
Yep.
recording ourselves, I would still do this. It's so fun.
that skit is like where basically it's where you could take all your trash opinions and put them into a podcast so that they don't need to be listened to by anyone.
Yeah, it's like it's literally a Fisher Price podcast, right?
Yep. Yeah. And yeah, I mean, absolutely. Like I think that there is something about bucking a convention in asset management that is just tiring because like, the second you go and you're like, oh, okay, well, I'm going to try and go a little bit beyond common practice.
Yeah.
It's not like you're just like, it's not like you're at the level of having to reinvent Excel. But the sort of soft infrastructure, the mental models, the way of explaining what you do to other people, really needs to be invented again out of full cloth. And, I'm really pumped to be on the Predistribution Initiative's email list so I can keep abreast of all the great stuff they're doing.
Before we move on, it's funny when we connected, I've been hearing about their work for a little while, but we really only connected around the private equity transparency project coming out of the SEC, which they're commenting on. And it was like this crack in the door that was like, wait, what else are you doing? And it's like, oh my gosh, they're like, their initiative is almost the same as our initiative. It's like, and they even were smart enough to call it an initiative like us. You know what I mean?
I mean, yeah, all the real G's.
I'm wondering if we should contemplate a free money initiative.
I mean,
there's a lot of people like podcasts.
That's a good point.
Not many people have initiatives.
Yeah, that's true. I mean, in order to make it an initiative, do we need to like send free money to like people?
But aren't we?
That's true. Yeah. I mean, if we were to tally up the total value we've created with this podcast, it would be like tens of dollars.
It would be in the hundreds of cents.
Exactly. It would be, difficult. I mean, I think that you need to move out of, base 10 numbering conventions, you got to get into like base 16 in order to fully appreciate, what we do here.
Yep.
Anyway, it's time for not only a flawless transition. Wow. Only a 7-minute delay on that.
All I heard was you groaning, making some weird
noise. That's my pterodactyl voice.
Yeah, exactly. I didn't even hear I didn't get to hear the sound effect. Is this the hard things?
This is the hard thing. Yeah. What's been hard for you?
So I have an admission to make. The hard thing this week was remembering to do the hard thing. And it's, what? We'll turn it into a real thing. I feel like I forget a lot of stuff when you're building so much.
Yeah.
If you don't keep a lot of lists and like, what was it? The checklist manifesto. I need to like recheck my checklist for free money, maybe more than 20 minutes before we go live.
That's definitely a good idea. I mean, I also need to do that.
20 minutes before going live, I was like, oh shit, what am I doing for these things?
Shit. I mean, mine this week, mine's kind of, I guess mine are all recently have always been like kind of good things that are like just stress inducing. Hopefully, we will be, Invest Vegan will be live on the Charles Schwab TAMP platform before too long.
That sounds like a big deal.
It's a pretty big deal. Yeah. It means that any RIA who uses Charles Schwab will be able to use the Invest Vegan, ethical growth strategy with their clients. Right. So, and just kind of pipe it in and, use it the same way they would use any other kind of active mutual fund strategy.
How many vegan competitors do you have out there? Just out of curiosity.
So, it's really, really interesting. There's a veganfinancialprofessionals.com has a bunch of people who've been doing this since like before I was born, basically. And they tend to be, they all have their own distinctive approaches to kind of veganizing investment management. Usually they're stuck using financial products that have been made by other people, and sort of like pressuring them to do better on various things.
It's engagement rather than security selection.
Exactly.
Okay.
Exactly. And also client education, right? Like about what's possible and, and so on and so forth. And, really just some great CFPs and other folks who are doing a lot of good there. There are also 2 vegan ETFs, VEGN, which is a sort of like, broad-based index that has a lot of tech stuff. And then there's EAT-V, which is more focused on like vegan food innovation specifically. Both are pretty distinct, are pretty different from what I do in terms of like the various frameworks and stuff. But there's definitely a lot of investment capital moving into this sector, and a lot of like kind of latent client demand that I've noticed.
Yeah.
Like pretty much all of my discussions with clients go really, really well. And I sense that there's a lot of demand from advisors to
like this one.
Yeah, like Dr. Ashby Monk himself. But so far my clients hilariously are like mostly institutional investment geeks investing their personal money.
Yeah, like this one.
Exactly. Yeah. So like, it's pretty funny actually that, I sort of thought it would be like, people from like my food co-op who would be the majority of clients, but it's like listeners to the Free Money podcast.
Yeah. Which is why you got shark bait out there.
Yeah, exactly. Yeah.
Thank God for shark bait.
Thank God for shark bait, baby. Yeah. But it makes total sense. But, it's like, it's hard to simultaneously do the asset management and produce materials for advisors to think about using it.
Yeah.
And like respond to, like I've started to get interest from like institutional folks who are like sending me questionnaires and saying like, hey, but that's all like, they'll send you like a 2-page questionnaire with 15 long questions on it. You got to write that out.
Sounds like you're building a business and you might need to raise some funding.
I guess, is that what people do at this stage?
Yeah. Yeah. So you have a product, you have a slight product market fit. You definitely have MVP out there. But now what you need is to think about how you scale it.
That's a good point.
And so, maybe we were breaking lots of rules by even talking about it. Who knows? We'll have to have shark bait later. But like, I think that would be my advice to you is like, let's think about how we raise a little bit of equity financing for your partnership. But then again, maybe you don't want anybody on your partnership. This is hard.
I mean, the right people, who knows?
Yeah.
That's a good idea.
Yeah, no, you're welcome.
Yeah, exactly. We'll talk about that. Let's talk about that after the
Take
show.
that offline.
Yeah, exactly. But, before we get to that, we got the very important, the Dear Ashby segment of the show, which is this is where we talk about, whatever's on your mind, beloved listeners. And, just as a reminder, you can ask questions at this time and we will answer them. Even if they are, in one of these cases, pretty fun, pretty weird. So like, don't hesitate. Don't censor yourself. Ask whatever's on your mind. freemoneypod@gmail.com, or just, there's a forum you can get to at freemoneypodcast.com. This is like, I think you were at Alts LA.
I was,
last little bit. I think this comes out of that conference where a lot of people were talking about the democratization of alternative investing. And a lot of firms seem to be shifting into quote unquote asset gatherer mode.
Yeah.
Right. These are like big private equity sponsors who are like starting to, tap into retail demand and raise bigger funds from broader groups of people. Would it make you nervous if you were a longstanding LP to see a firm doing that? What sorts of warning signs would you suggest folks look out for that a firm's focus may be shifting away from generating like pure investment returns?
Be a major red flag. Major.
Yeah.
Like, so first of all, I'm not just talking about asset gathering, because there's certain asset classes for which capacity is less of an issue. If you're BlackRock, the size of the markets they're going after, they're obviously an asset gathering firm, and there's probably capacity in all those. Most of the alternative spaces have capacity constraints. So if in order to get bigger, you have to change your strategy. And anytime you change your strategy by, a lot of people in the venture community, by the way, they'll start out doing angel and seed deals, and then they'll go pro doing Series A. Those are two different jobs. Those are two very different jobs. So I think asset gathering is like the step before your political career, and 2 steps before buying a pro sports team after you failed at politics. So that's how I think about asset gathering and the alternatives.
So based on that, like the Bridgewater, the guy, is running for Senate, we should expect this.
Oh shit. Yeah. They were gathering assets along. Some of those macro hedge funds, to give them credit, there's big capacity.
They're much more liquid.
Yeah.
They're playing like
trading currencies. Like, the size of those trades are massive. It's more like mid-market buyout. Like, they also have a thing called the fourth fund rule. The sweet spot is your second fund, because you don't have your billions yet. But when you get to the fourth fund, like, you're ready for your sports team and your political career. And you've lost
makes
focus.
a lot of sense.
And so at that point, it's really about the next generation. And then you're really like diligencing the GP's ability to transition authority from one generation to the next. That's the fourth fund.
Yep. Yeah. And then you kind of are relying on them to solve questions around like attracting and retaining diverse staff, which, as we know, they're all great at. But yeah, I mean, like the ratio of time spent actually investing to like marketing is a great indicator, I think, of like the quality of an asset management firm.
Aren't you having your eyes opened? It's fun to actually talk to you about this, because even I am having my eyes open to the challenge of building businesses in these spaces.
I know it's like, it's really kind of fun. I feel really lucky for the ability to like do it kind of out loud like this, because like I don't think that it's a well-trodden path, really. And like the nature of the demands on your time change so weirdly, and like I think that there's just like unlimited things to say about it, but the ultimate thing is that we all need naps.
Yeah.
Everybody needs a nap. The next question is about the rise of inflation and the associated rise in commodity and energy prices. This is a great one. There's like relative underperformance by ESG funds over the most recent quarter. Does this presage anything meaningful? Like the take for a long time, like in the COVID pandemic, was like, wow, ESG is outperforming in this time of volatility, but now the type of volatility we're getting is quite different, and ESG is lagging. What do we take from this, if anything?
So part of me wants to just like blame the benchmark again, because
always a good strategy.
Like we could go there. We don't even know what we're saying really, but people are like, that's smart. That's smart. So we blame the benchmark, in part because I think ESG has a different risk return profile and is going to, like, those risks are priced differently over time.
Yeah.
I mean, the beauty of the fossil fuel industry, if you're investing in it, is they're still enjoying unpriced externalities, whether it's like no price on carbon, no gas tax in certain jurisdictions, let alone like actual subsidies of fossil fuels for energy security. Like there's a lot that fossil fuel companies are still trading on that like ESG indices are already kind of pricing in. So I guess like where my brain goes is like, and I don't have a solid answer. The ESG is like the folks are already trying to integrate these future externalities into portfolios because the expectation is 10 years from now, this stuff will be priced. But today it's not.
Yep.
And so there is this like time machine problem that the ESG is sort of investing for the future world, and the fossil fuel is investing for, today and yesterday. And so it's natural to see a disconnect between those two kind of benchmarks. I don't know what I'm talking about, but
I think that's a great frame.
Okay.
I mean, like I think like if you look at the commodity returns, they're characterized by periods of incredibly strong performance followed by reversion to the mean. And like I guess, when I saw this, these headlines coming around, I was like, well, is that kind of a sell the news moment? Because generally by the time you get around to like banking on the continued upswing in oil prices, the upswing is behind you.
yeah.
And you see the spike and everyone's like, oh my gosh, the world has changed. And then, more drilling capacity comes online and prices go down. And like, I'm not making that call. I would never do that. Because I do enough crap already. But yeah, like it's hard to really, I mean, a quarter's performance is always going to be meaningless. But like, with, will inflation, ruin ESG? Nothing has so far. I don't see why inflation would.
Yeah. Yeah. It's a
you know.
good question. I don't know.
Yeah.
I don't know enough.
Yeah. I
about
guess we'll see.
all the consequences of inflation, except that that's like the Fed,
Yeah. Well,
like, the Fed, you'd be like, hey, inflation is up. Oh, Fed's going to kill us. And then markets crash.
I mean, from a long-term standpoint, it's funny. I have Burt Malkiel's Inflation Beaters Investment Guide
Ooh.
that and for anybody who knows Burt Malkiel, he wrote Random Walk Down Wall Street.
Yeah.
He's a big advocate of keeping investment strategies simple, keeping fees low.
He was my college professor.
No way.
Yeah. I took his class, investments. He was hilarious.
I did not realize that.
He used slides with professional wrestlers on them.
Oh, man. And apparently he's a big horse racing fan.
That could be true. That could be true. The funniest thing about that is he's telling a story about a random walk on Wall Street, and then he's like, nudge, nudge, wink, wink. He's like, I do active management on my own account.
Yeah, I mean, but he's Burt Malkiel, and most of us aren't.
Exactly.
But yeah, like so in his book in the 80s, he was like, common stocks are usually the right move. To hedge that out, and I think that that's right. Like, in general, you're going to do better with common stocks than you are, in non-common stocks or in preferreds or bonds or whatever. Probably for emergency funds, it makes sense to use those like inflation-linked Series E bonds. If you're like a person who, has an emergency fund in cash, that's a material part of your financial outlook.
Yeah.
But yeah, anyway, that's a lot about inflation. Let's get to the most important question of this segment.
Hit it.
So Kylie Jenner
God.
and Travis Scott recently changed their child's name from Wolf because they, quote, didn't think it was him. Under what circumstances would you change your children's names?
So I was like at first wondering, like, this child is literally not a wolf.
No, but the kid's name.
I know. And then, but then, so I was at first like, are they just being literal? Like,
we thought we gave birth to a wolf.
yeah, it's not a wolf. It turns out.
We need better medical advice.
So there's a little bit of a crabby part of me, which is like, you know what? A kid's name, feels like them when you spend a ton of time with them. And so I almost wonder if Kylie Jenner and Travis Scott, by the way, Travis Scott just had that concert in Texas where everybody died, I think.
Oh, that's right. I forgot about
I'm wondering
that.
if they didn't quite spend enough time with Wolf for Wolf to feel like Wolf. You know what I mean? I don't want to give parental pressure, but I'm just saying, like, in my experience, the name and the being kind of begin to feel together. But that's not to say there aren't good reasons to change names. I think there are.
Yeah.
You see it a lot when you're crossing borders. Myself, when I was living in Paris for 3 years, and my wife. So my name is Ashby, which everybody would ask me, what is that short for? Because that is HB. And so my name was, and my middle names, for those that don't know, are Henry Benning. So my name was Ashby Monk. Ashby. And they would be like, what are all the letters? Like, what's the HB and the HB stand for? And I would be like, no, my first name is Ashby. Ash, you know? And
I'm the man so
it
nice to
was
name
so
twice.
freaking confusing. And then my wife's name, Courtney, means short nose. Okay. And so like I have experienced what it, and by the way, the classic in India, and I've met somebody named Hardik, which means congratulations in Hindu.
Yep.
Okay.
Yep.
Great name, Hardik. Probably
Yeah.
tough if you were a kid here with that name. Okay. So I think it's totally reasonable for human beings that are crossing borders to switch it up.
There's some great papers on that, actually.
Really?
Yeah. The economic payoff of name Americanization. If you let's say if you were named Hardik, and you change your name to like Joel or something,
There's a payoff.
There's a significant like double-digit lifetime earnings payoff to making that.
But your likelihood of being a comedian goes way down because I think being made fun of as somebody who came with the name Ashby from Canada.
Oh yeah.
I had a
Yeah,
weird
yeah,
name
yeah.
growing up. People be, you know, you're from Canada, you know. I think it makes you funnier because you just have to be faster at responding to everybody making fun of you. You know, you live or die. Anyway.
So basically, if you moved to France, you would consider it.
Well, I would
Uh,
because I don't think like it wasn't that hard to like explain. you know.
Yeah.
But it would be hard. You know, I can imagine there are kids. So I don't understand the Wolf one. I think Wolf actually is a pretty rad name.
It's actually there's a family friend growing up was this guy Wolf Nadelman, who's actually like the one of the big characters in Liar's Poker. It's the only person who went on the record for Liar's Poker, and thus the only person who was unemployable on Wall Street afterwards. He became a pediatrician in
How
California.
funny. $1 million, no tears. I love it.
Yeah, exactly.
Yeah.
Yeah, it just but like, yeah, I mean, I always thought that was a really cool name, although he spelled it with 2 F's, not
Well, there's always the Blitzer, you know? Wolf
Wolf Blitzer. Wolfie boy.
Which has to be a
Blitzer.
made up name because it's too damn good. Wolf Blitzer.
It's such a good name for a journalist,
Isn't it? It's like Max
yeah.
Boot.
Oh,
Another
Max
like
Boot is great.
name that you're like, is that really your name? Max Boot?
Sounds like a pro wrestler.
And he writes about like conflict. It was like too good.
Yeah.
Anyway, that's our naming chat. See,
Yeah,
each
exactly.
channel will answer your questions if you ask them.
Add not well more than you actually want.
Far more than you expected. Garden tip. Garden tip. Here we go.
We need to get Sharkbait back in here for like, here's the guy.
Here's your garden tip. Can you get somebody else? Like some kind of like a hippie person to talk about the garden tip? You know what I mean?
Hey man, here's your garden.
Yeah. Hey. Maybe we just do it. We're pretty good.
Yeah.
You know what I mean? Okay, here's my tip.
Yeah.
I did the work on this one because I have a Mason bee house in my yard. And it is time for you to all go out and get a Mason bee house. The benefit of Mason bees far exceed the regular honeybees or bumblebees.
Yep.
They are 120 times more effective at pollinating because those other bees have to support their colony. Mason bees don't. They just keep bopping around across those flowers. Yep. And they're also not as aggressive as honeybees. So like if they're going to be flying around your yard, you don't have to worry about them. They're not going to come and sting you or bite you. And so they're really good things to have in your garden. And there are cute little Mason bee huts, which have these little holes in it. You hang them 6 feet off the ground. People are like, what is that thing? And you're like, oh, and then you get to explain how cool you are with your Mason bee house and say everything I just said.
And they're literally like $10. I have one too.
Oh, yeah. They're like the most fancy one you could get is $39. Like they are, you know, you could get one for $5 probably.
Yeah. I mean, these solitary bees are really just remarkable at at pollinating it. And I mean, we always think about honeybees because that's like our extractive mindset as people. Right?
Yeah.
Like, it's like, what
can we get out of these guys?
Yeah, exactly. But like,
You're keeping us alive with pollen, but what else?
yeah, exactly. Like, I want to drink your food.
Oh, Jesus.
If you think about it,
It's good for allergies. Sloan, it's good for allergies.
That's true.
Local honey.
Yeah, that's true. I
What's
mean,
your
that's my tip is that, like, as in investing, most issues with gardening are fundamentally about time horizon.
Interesting.
So like at a time like now when, most of us are thinking about what we want to get in the ground and stuff like that. Like, I think that there's a pressure to like have the biggest display possible as soon as like the frost is gone here, or like, and certain people don't have to worry about that. But like I think it's much more important to ask yourself questions about like the program that you want to have in your garden. Like, do you care about sourcing organic seeds, for instance, right? Do you care about like, having a good compost cycle up and running? If you have programs like that set up, the failure or success of any individual plant is much easier to bear because you can be like, oh, well, this dead plant is just more compost.
Yeah.
And so like, I think as we get into the season, it's important to foreground that kind of attitude, because it will help avoid tears later on down the line.
I love that. And it's the classic thing also around the time horizon of gardening, which is like the best time to have planted a tree is 10 years ago, barring that is today,
Yep.
And so it's like these things take time and you need patience and you got to like plant a lot of seeds, expecting some of them to drop dead along the way. So understanding that time horizon and really plugging it all together, that's part of the fun of this gardening gig.
Yeah. It's like, I mean, like some people wonder why we talk gardening tips on this investing podcast, but the two practices could not be more related.
Oh yeah. You totally planned this.
Yeah, exactly. In no way did we just go, oh crap, we're both really into gardening. All right, let's make a podcast.
No way
about that
did
too.
we just have something in common and then want to talk about it. This is all investment related. We're freeing the confines of capital, whatever we're done. We've unshackled capital.
I would like you all to know before we sign off for this podcast that Ashby's glasses just fell off of his forehead onto his eyes in a very dramatic fashion as he talked about that.
All right. We love you guys.
Bye.
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 I'm looking like money, 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 money. Now make it rain on 'em.